Somewhere along the way, someone convinced you that buying a stock is basically gambling, a scratch-off ticket you buy hoping the number goes up. So you either stayed away from it entirely or you treated it like a casino. But a share of stock isn't a lottery ticket. It's a tiny, legal piece of a real business. A slice of the factories, the brand, the workers, and the profits of an actual company that sells real things to real people. Today, I want to show you what a stock truly is, and then hand you the single most powerful idea in all of investing: how, for the price of a coffee, you can own a tiny piece of the entire economy at once, and why that quietly beats trying to be clever. Here's the plan for the next few minutes. This is episode 3 of a series about building one machine that turns money into more money for the rest of your life. Episode 1 was why you switch it on. Episode 2 was the engine, compounding. This episode is the first kind of fuel you pour in, stocks, the growth fuel, and I'm going to hand you 6 gears. 1, what a stock actually is, ownership and a claim on real profits. 2, one stock is a single fragile egg, but an index fund is the whole basket. 3, why trying to pick the winners is a loser's game for almost everyone. 4, diversification, the closest thing to a free lunch that exists. 5, why the stomach-churning swings are the price of admission, not a malfunction. And 6, the one edge you fully control, keeping costs low. Let's start with what you're actually buying. So let's kill the lottery ticket idea right now. When you buy one share of a company, you don't buy a flashing number on a screen. You buy a small ownership stake in a living business. You become, in a tiny way, a part owner. If the company has 1,000 shares and you hold one, you own 1,000th of everything it has and everything it earns. A sliver of its buildings, its inventory, its future sales, and yes, its profits. That's it. A stock is ownership. When the business grows and earns more, your little slice is worth more, and it can pay you part of those profits along the way. You're not betting on a number. You've hired a whole company to go to work for you. This one shift changes everything about how you behave. A gambler stares at the screen, praying the number jumps by Friday. An owner asks a completely different question. Is this a good business that will be worth more in 10 or 20 years? The gambler panics when the price drops. The owner remembers they own a slice of something real that's still out there selling things, whether the daily price is up or down. Now, here's the honest catch, and it's the whole reason for the rest of this video. Owning one business means your entire outcome rides on that one company, and single companies fail all the time, even famous, safe ones. So the goal isn't to stop being an owner, it's to stop being an owner of just one thing. Which brings us to the 6 gears. Gear 1. A stock is a share of ownership in a real company and a claim on its profits. Nothing more magical than that. Let's make it concrete. A company needs money to grow, so it splits itself into many equal pieces called shares and sells them to the public. Buy a share and you legally own that fraction of the business. 2 good things can now flow to you. First, if the company becomes more valuable, more customers, more profit, a bigger future, the value of your share rises with it. Second, many companies hand out a slice of their profits directly to owners as a cash payment, a dividend that lands in your account just for holding the share. That's the whole deal. You are not lending the company money. That's a bond, and we'll cover it next episode. As a stockholder, you are an owner. You share in the upside when the business wins, and you share in the pain when it struggles, because your fortunes are genuinely tied to a real operating company. So why do stocks, as a group, tend to grow over long stretches of time? Because the economy tends to grow. Businesses invent, sell, expand, and earn more decade over decade. And as a part owner of those businesses, that growing pile of profit is partly yours. A stock isn't a magic number that goes up. It's a claim on the ongoing work of real companies, the people showing up, the products shipping, the sales ringing up day after day, whether you're watching the ticker or not. Understand that, and you'll never see a stock chart the same way again. Gear 2, and this is the most important idea in this entire series. You've heard, don't put all your eggs in one basket. In investing, that isn't a cute saying. It's the whole strategy. A single stock is one egg. It might be a wonderful egg from a wonderful company. But if that one company stumbles, gets disrupted, or simply fails, your egg cracks and a big chunk of your money can vanish. Now here's the tool that changes the game: the index fund. Let me define it plainly, because this term unlocks everything. An index fund is a single investment you can buy that automatically holds a tiny slice of hundreds, or even thousands, of companies at once. Instead of buying one egg, you buy the entire basket in one move. When you put money into a broad index fund, you instantly become a part owner of a huge cross-section of the whole economy. Big companies, small ones across many different industries, all bundled together for a few dollars. And here's the beautiful part: you don't have to know which companies will win. You own so many of them that you simply capture the growth of the group. If one egg cracks, it barely dents the basket because it was only a tiny piece of the whole. And notice how little work this asks of you. No research reports, no watching the news, no agonizing over which company is about to soar or sink. You buy the basket, and you own the group. One stock bets on one story, and stories end. An index fund bets that the economy overall keeps moving forward, which over long stretches it has tended to do. For almost everyone watching, that basket is the answer. Gear 3, and this one bruises the ego a little, so stay with me. Trying to pick the individual winning stocks is a loser's game for almost everyone, and that includes the professionals. It feels like it should work. You do some research, you find a great company, you buy it, you get rich. But here's the reality the industry doesn't advertise. The market price of a stock already bakes in everything the whole world knows about that company right now. Every earnings report, every rumor, every hope. To beat the market by picking, you don't just need to be right. You need to be right about something the millions of other smart, full-time, deeply resourced investors got wrong. That's incredibly hard. And we can measure how hard, over long periods, the large majority of professional fund managers, people who do this all day with teams and supercomputers, fail to beat a simple broad index fund. If the pros mostly can't do it, the honest odds that you, picking a few names in your spare time, will consistently beat them are not good. And there's a quieter trap. Even when you pick a winner, you often own too little of it to matter, or you sell it too early out of fear. This isn't an insult to your intelligence, it's just the math of an extremely competitive game. The winning move for regular people isn't to play that game better, it's to refuse to play it, own the whole basket, and take the market's growth without the guessing. Gear 4. There's an old line among investors that diversification is the only free lunch in the market, the one thing that gives you something for nothing. Let me explain why that's literally true. Normally in investing, to get more reward, you have to accept more risk. That's the price of everything. Diversification is the rare exception. When you spread your money across many different companies instead of a few, you dramatically cut your risk. But you do not cut your expected return. You get lower risk for free. Here's the intuition. Imagine you own just one company and it goes bankrupt. You can lose nearly everything. Now imagine you own 3,000 companies and one of them goes bankrupt. You lose a tiny, almost invisible sliver while the other companies carry on. The disasters get diluted into nothing, but, and this is the key, you still fully capture the growth of all the winners in the basket because you own them too. You've smoothed out the terrifying, jagged ride of a single stock into the much steadier climb of the whole group without giving up the climb itself. That's the free lunch, the same long-term growth engine with a huge amount of the one company blows up and ruins me danger simply removed. You don't get diversification by being smart or lucky. You get it automatically the instant you buy the broad basket instead of the single egg. It is the closest thing to magic that honest investing offers. Gear 5, and this is the one that saves you from yourself. Stocks bounce, they surge, they slump, and every so often they crash hard. And that is not a sign something is broken. It's the toll you pay for the long-run growth. Let me reframe the thing that scares everyone. The reason stocks tend to grow more than a savings account over decades is precisely because they don't grow in a smooth, guaranteed line. If the ride were calm and certain, everyone would pile in and the extra reward would disappear. The bumpiness is the reason the reward exists. So think of volatility, the fancy word for how much prices swing up and down, not as a malfunction, but as the entry fee for the growth. Here's the mental model. The swings are the turbulence on a flight that is, over the long haul, steadily climbing. Turbulence feels awful. It is also completely normal, and the plane keeps flying. The single most destructive thing an investor can do is feel the turbulence, panic, and sell at the bottom, turning a temporary dip into a permanent loss. The person who understands that the drops are the price of admission simply stays buckled in and lets the flight continue. Remember, past performance never guarantees the future, and no drop is promised to recover on any timeline. But historically, broad baskets of stocks have weathered crash after crash and, given enough time, kept climbing. Volatility isn't the risk to run from. Selling because of it is. Gear 6, and it's the one edge that's fully 100% in your hands. You can't control what the market does tomorrow. You can't reliably pick the winners. But you can control exactly one powerful thing: how much you pay to invest. And it matters far more than almost anyone realizes. Every fund charges a fee, usually quoted as a small yearly percentage of your money. It sounds tiny. 1% here, 0.5% there. But remember the engine from episode 2. Compounding runs in both directions. A fee charged every single year and compounded over decades doesn't nibble a little off your final pile. It can quietly devour a shocking slice of it because it steals not just the dollars, but all the growth those dollars would have produced for the rest of your life. Here's the brutal asymmetry that makes this the smartest move you can make. Your future returns are uncertain. Nobody can promise them. But the fee is certain. It's the one number you know for sure. In advance, guaranteed. So the logic is simple. Since you can't control the returns, control the cost. A broad, low-cost index fund does exactly this. It gives you the whole basket, the diversification, the market's growth, while keeping the fee as close to nothing as possible, so the maximum amount of that growth stays with you instead of leaking away. Low cost isn't glamorous. It's just the closest thing to a guaranteed edge that investing has, and it's the one nobody can take from you. So how do you actually put this to work? How do you go from stocks are scary gambling to owning a slice of the whole economy calmly this month? The recipe is short and almost boringly simple, which is exactly why it beats the clever stuff. First, think like an owner, not a gambler. You're not buying flashing numbers to flip by Friday. You're buying tiny pieces of real businesses to hold for years, so let the daily price noise wash right over you. Own things, don't trade them. Second, buy the basket, not the egg. Instead of hunting for the one perfect company, own a broad index fund that holds a huge cross-section of the market in a single purchase. You get instant diversification, the free lunch, and you capture the whole group's growth without needing to guess the winners. And third, keep the cost as low as you possibly can, and then leave it alone. Choose the broad, low-cost option because the fee is the one certain number in the whole equation, and then let volatility do its noisy, normal thing while you stay buckled in for the long climb. That's the entire strategy for the growth fuel. Be an owner, own everything, pay almost nothing, and don't flinch when it bounces. Notice what's not on the list. No picking, no timing, no predicting, no watching the news all day and reacting. The whole thing is designed to be set up once and then left mostly alone, which is exactly why ordinary people who follow it tend to do better than the folks frantically trying to outsmart the market. You don't need to be a genius stock picker. You just need to own the whole basket and get out of its way. So tell me in the comments, before this video, did you think of stocks as gambling or as owning a piece of a business? That one reframe changes how you'll invest for the rest of your life. And remember, this is education, not financial advice. Just the map, laid out honestly so you can make the call for yourself. All the returns here were round, hypothetical illustrations, never promises, and past performance doesn't predict future results. Next time, we pour in the other half of the fuel, the boring half that quietly saves you. Bonds and cash, the ballast in the hull that keeps your whole machine from capsizing when the storm hits. Growth is only half the story. Stability is the other half. I'll see you there.